Usually when we talk about a booming economy, we look for highly visible, tangible metrics. Like we look at retail spending, or we watch for sold signs popping up in our neighborhoods, or
Right, or we see packed restaurants on a Tuesday night.
exactly, Main Street
The
economics.
stuff we experience every single day.
Yeah. But then you step into the world of global technology infrastructure, and suddenly the biggest economic booms are, well, they're completely invisible to the average person on the street.
Oh, absolutely. The scale is almost unfathomable.
It really is. So welcome to today's deep dive. We are taking a highly concentrated, super jargon-heavy financial note about, quote, hyperscaler Capex spend. And our mission today is to translate what that actually means for the global technology market.
Which is so important right now.
It is, and whether you are an investor, a tech worker, or just someone trying to understand where the economy is headed, tracking this specific money trail is just critical.
It's essentially the blueprint for the next decade of technology. I mean, the numbers we are looking at represent a massive foundational shift happening right beneath the surface of all our consumer tech.
Okay, let's unpack this. We need to start with the core thesis of the source material you shared with us today, which relies on a very specific piece of internet financial slang.
Yes, it does.
The overarching signal here is that upstream semiconductor supply chains are going brrr.
Going brr.
Right, like a money printer just jamming out bills at maximum speed. Brr.
Which, honestly, is a very colorful way to describe an incredibly serious macroeconomic event.
Yeah, totally.
And the crucial point here is that this Burr effect exists entirely apart from just, looking at the stock ticker of a company like Taiwan Semiconductor.
Right, the big chip maker.
Yeah, I mean, yes, they make the chips, but looking only at the chip manufacturer is kind of like looking at a thermometer to understand a hurricane.
Oh, that's a good way to put it.
We need to look at the storm system itself. We really need to look at where all that pressure is coming from.
And that pressure is coming from the hyperscalers,
Exactly.
which, for anyone not steeped in enterprise tech architecture, hyperscalers are the titans of the industry. These are the massive companies that operate data centers and cloud infrastructure on a truly global scale.
We're talking about the infrastructure of the internet itself here.
Right. And the specific metric we are focusing on today is their Capex, or capital expenditures.
Yeah, and to put a finer point on it, capital expenditure is the money a company spends to buy, maintain, or improve its physical fixed assets.
So not software.
No, not software. In the context of these hyperscalers, CapEx isn't paying developers to write code. It's the physical, hard reality of artificial intelligence.
The concrete, the wires.
Exactly. The specialized cooling systems, the thousands of miles of fiber optic cables, and of course, the raw silicon chips.
And we also need to define that word upstream from earlier. Because when we say money is flowing into upstream semiconductor supply chains, we aren't talking about buying a finished servo rack, right?
No, upstream means the very beginning of the river.
Right. We are talking about the companies that fabricate the silicon wafers, the companies that build the highly specialized lithography machines, the raw materials.
That is exactly where the money printer is going into absolute overdrive.
Because to understand how fast this Brrr economy is moving, you really have to look at the behavior of the companies that are actually signing the checks.
Which brings us perfectly to Meta.
Oh, yeah. Looking at their recent revisions paints a very, very intense picture of the current market reality.
It's staggering.
It is. Originally, Meta projected their 2026 fiscal year capital expenditure to be between $115 billion and $135 billion.
A massive number already.
Right. But in their revised Q1 earnings report, they hiked that projection significantly. They pushed it up to a range of $125 billion to $145 billion.
Which is just wild to think about.
They essentially tossed an extra $10 billion onto their infrastructure budget in a single quarter.
What's fascinating here is the specific mechanical forces driving that upward revision. Because, it's not just a generic desire for corporate growth.
Right, it's more targeted.
Much more. The analysis points to three distinct pressures forcing Meta's budget upward. Higher component prices, incredibly aggressive AI infrastructure spending, and the immense demands of custom model training.
Okay, let me push back on that first driver for a second. Because if component prices, like the raw materials and chips, are actively hiking up,
They are.
right, does Meta's higher CapEx actually mean they are acquiring more technological capability? Or are they just being forced to pay $10 billion more for the exact same amount of infrastructure? Like, are they growing? Or is this just data center inflation?
It is a phenomenal question, really, because the reality is it's a feedback loop of both.
Oh.
When every major tech player wants the exact same highly specialized hardware at the exact same time, the upstream suppliers have absolute pricing power.
So they just jack up the rates.
They raise the prices, and the hyperscalers simply have to pay it. So yes, a portion of that $10 billion is just the toll of inflation in a highly constrained market.
But it's not the whole story.
Not at all. The other two factors, the aggressive AI infrastructure and custom model training, those are the real accelerators here.
Got it.
And we really need to pause and explain why custom model training is so insanely expensive. Because if you are running a traditional cloud server, it's handling, discrete, quick tasks.
Like loading a web page.
Right. You click a website, the server retrieves the data in a fraction of a second, and then the processor idles. It takes a break.
It's a quick sprint, then a rest.
Exactly. But training a custom large language model, that is a marathon run at a full sprint.
Wow.
You are taking arrays of tens of thousands of specialized chips and running them at maximum capacity, at maximum heat, 24 hours a day for months on end.
Which requires a completely different architectural reality. I mean, you aren't just buying chips, you are having to engineer new ways to cool a building that is effectively turning into a massive furnace.
Precisely. And you are dealing with rapid hardware degradation, massive power draw from the local energy grid, and the need for ultra-fast networking cables so all those thousands of chips can talk to each other simultaneously.
Without even a microsecond of lag.
Right. So when Meta revises their budget up by $10 billion, it's because they are trying to build a much bigger, significantly more complex engine, while simultaneously paying a massive premium for the parts to build it.
Because if they don't buy those highly priced components,
someone else will. And they fall behind in the most critical technological arms race of the decade.
Okay, so that establishes the demand side of things. Meta is throwing billions at the market trying to secure their place. And the logical assumption for, a normal person is that with that much cash, you just buy what you need.
That would make sense, yeah.
But when you look at Microsoft's recent numbers, you realize that infinite money doesn't actually equal infinite hardware.
And this is exactly where the story shifts from financial strategy to the hard laws of physics.
Yeah. Microsoft's actual Capex spend came in at $31.9 billion. Obviously a massive number, but they were expected to spend $35.29 billion.
Right, a huge gap.
They missed their own target by over $3 billion. Now, in a normal corporate environment, Wall Street might actually applaud a company for coming in under budget.
They'd love it.
But the dynamic here is entirely different. The source points out Microsoft didn't spend less because they suddenly decided to be frugal or because they lacked the capital. They missed the target entirely due to severe supply chain bottlenecks.
And we really need to explore how that bottleneck functions mechanically.
Right. I think of it like this. Imagine Microsoft is a billionaire standing at the velvet rope of the most exclusive nightclub in the world.
Okay, I'm picturing it.
They have a briefcase literally bursting with cash, and they are begging the bouncer to let them inside so they can buy the most expensive bottles on the menu. But the bouncer physically cannot let them inside fast enough. The door is too small.
I like that analogy a lot, but we have to extend it to the physics of the supply chain. Because it's not just that the bouncer is slow checking IDs, it's that the nightclub literally only has so much square footage.
Right.
In the semiconductor world, that square footage is the manufacturing and packaging capacity.
Tell me more about the packaging side.
Yeah.
Because that seems to be the silent killer of these huge Capex dreams.
It really is. People often think of a computer chip as just a piece of silicon that gets printed and shipped in a box.
Like a cookie cutter.
Right. But the AI chips driving this boom require incredibly complex, advanced packaging. You're taking multiple different types of silicon, like memory chips, processing chips, and physically stacking and binding them together on a microscopic level.
Which sounds ridiculously delicate.
It is. It requires specialized machinery, highly controlled environments, and a significant amount of time. You have to literally bake and assemble these components.
You can't just throw an extra $1 billion at a factory and demand a chip bakes faster. I mean, physics has a speed limit.
Exactly. Physics does not care about your budget.
Yeah.
The factories run by companies like Taiwan Semiconductor are already operating at maximum capacity and building a new fabrication plant to increase that capacity. That takes years and billions of dollars in its own right. Sure. So Microsoft has the money, they have the intense desire to build the data centers, but the physical supply chains simply cannot spit the finished servers out fast enough to absorb their capital.
So the cash just piles up at the door. I mean, we have Meta pushing prices up by throwing an extra $10 billion into the ring. We have Microsoft proving that the demand is already so high that it's hitting the hard ceiling of physical manufacturing.
That's a perfect storm.
And then you add the final heavyweight to the mix, which is Amazon.
Yes, Amazon, under ticker symbol AMZN. While the market is still waiting for their official finalized reporting, the context we have from CEO Andy Jassy's earlier note points to an absolutely staggering Capex figure.
What's the number?
Approximately $200 billion.
$200 billion.
Yeah.
That is, I mean, it completely eclipses the others. If we go back to the idea of a money printer going brrr, Amazon isn't just running a printer. They are operating a national mint.
If we connect this to the bigger picture, you see the inevitable conclusion here. The demand from these three hyperscalers alone mathematically outstrips the global supply capacity
By a mile.
by a huge margin. When you have multiple companies backed by hundreds of billions of dollars trying to squeeze through a singular manufacturing bottleneck, the supply chain dictates all the terms.
The upstream companies don't even have to look for buyers. They just sit back, raise their prices, and let the capital wash over them.
Which is exactly why the source notes that it's virtually guaranteed these upstream semiconductor names will keep going brrr well into the next quarter.
Because where else is the money going to go?
Nowhere. The money is funneled directly into them. The hyperscalers have to spend it to stay competitive, and the demand physically outstrips the supply.
Which naturally forces us to zoom out a bit. Because whenever you have capital moving on this kind of massive scale, just violently colliding with physical manufacturing limits, you have to look at the macroeconomic weather system overseeing it all.
You really do.
You have to look at the Federal Reserve.
Because none of this happens in a vacuum. The cost of capital dictates the speed of innovation.
Now, the source gives a very specific characterization of the current leadership dynamic at the Fed. And, as always, we are just reporting this neutrally to understand how the broader market is perceiving and reacting to it. We're not validating the central banking structure.
Right, just looking at the market perception.
Exactly. So the source points out a unique dual dynamic. On one hand, you have a, quote, new Fed chair, who the market perceives as being gung-ho all in on AI plus rate cuts.
Okay.
And on the other hand, you have Jerome, referring to Jerome Powell, operating in the background, keeping things chill, and providing a baseline of traditional stability.
That is a highly specific and very interesting psychological setup for the market to operate within.
Here's where it gets really interesting. Because historically, central banks are the ones throwing cold water on the party.
Right, they take away the punch bowl.
Exactly. They are naturally cautious. They were suspicious of hype cycles. If a particular sector gets way too hot, they worry about asset bubbles, they worry about localized inflation, and they step in to cool things down.
That's the traditional role, yeah.
But the source indicates the perception right now is that the new leadership is actively championing the AI movement while simultaneously pushing for rate cuts.
Which is an incredibly potent combination for the companies building this infrastructure.
But wait, doesn't this act like pouring rocket fuel on a fire that is already burning too hot for the supply chain to handle? I mean, if the supply chain is already bottlenecked and prices are inflating because Meta, Microsoft, and Amazon are fighting over limited chips,
Yes.
why would the Fed want to lower rates and make it even easier for them to spend? Doesn't that just make the bottleneck worse?
It's a brilliant observation, and it really highlights the tension between macro stability and microinflation. And the short answer is yes, it acts exactly like rocket fuel.
Wow.
To understand why the market loves this setup, we have to look at how these massive data centers are funded. Even for a company like Amazon or Microsoft, dropping $200 billion on infrastructure often involves leveraging debt.
They don't just use cash on hand?
Not always. They issue corporate bonds, they take on massive loans to finance the real estate, the power grid connections, the hardware itself.
So it's incredibly capital intensive.
Highly capital intensive. So when the Federal Reserve cuts interest rates, the cost of borrowing that money drops. Capital essentially goes on sale.
Ah, okay.
For a hyperscaler, a lower interest rate dramatically changes the math on a 10-year data center project. It lowers their operational overhead, which basically encourages them to be even more aggressive with their Capex.
They can afford to buy more expensive bricks for the castle.
Exactly. So you have this fascinating setup. A central bank perceived as actively lowering the cost of capital to fund the AI revolution, paired with the veteran presence of Jerome Powell in the background, keeping stuff chill so the broader bond and equity markets don't panic.
It's the perfect greenhouse environment.
Yeah.
I mean, the Fed is providing the fertilizer with cheaper debt. cheering on the growth of the AI sector and ensuring the temperature stays regulated in the background.
And that greenhouse effect guarantees that the demand funneling into the upstream supply chain isn't going to slow down anytime soon.
The hyperscalers are strongly incentivized to keep spending, which means the bottleneck will persist, which means the pricing power absolutely remains with the semiconductor manufacturers.
They hold all the cards right now.
Let's bring this all together for you, listening right now. We've covered the micromechanics of chip packaging and the macro dynamics of central banking. But what is the unified takeaway here?
It's all connected.
It is. Understanding the insights in this deep dive means recognizing that beneath all the flashy, consumer-facing AI hype, beneath the chatbots writing emails and the image generators making funny pictures.
The stuff everyone sees.
Right. Beneath all of that, there is a massive foundational shift happening in the physical economy.
Because the software is just the interface. The real story, the true economic engine, is the hardware reality being built to support it.
Trillions of dollars are fundamentally rerouting. We're watching a river of capital flow from the balance sheets of Meta, Microsoft, and Amazon straight through the physical bottlenecks of manufacturing and directly into the upstream semiconductor supply chains.
It's a massive wealth transfer.
And if you want to know where the global economy is going, you don't look at the software startups. You follow this Capex river. It tells you exactly where the physical foundation of the future is being poured.
And it shows you who holds the actual leverage. The companies that own the manufacturing capacity, the lithography machines, the raw silicon up.
They are the ones collecting the toll on every single dollar of this technological revolution.
They really are.
So what does this all mean?
Well, it leads us to a final, really provocative thought to mull over, one that extends far beyond this quarter's earnings reports.
Okay, let's hear it.
We've established the reality of the bottleneck. We know Microsoft's billions are already piling up at the door because the factories are at physical capacity.
Right.
And at the exact same time, we have an AI-enthusiastic Fed lowering interest rates, which actively encourages companies like Meta and Amazon to dump hundreds of billions of dollars more into that exact same bottleneck.
It's literally an unstoppable force meeting an unmovable object.
Precisely. We have an economic system currently running on the assumption of infinite digital demand. But digital demand requires physical hardware.
It does.
So the question becomes, at what point does the physical reality of global manufacturing simply break under the weight of infinite capital? I mean, when you have hundreds of billions of dollars demanding silicon that physically takes months to bake and package, something eventually has to give. Do the supply chains fundamentally restructure? Do the hyperscalers run out of physical space and power grid capacity to put these servers? Or does the AI arms race hit a physical speed limit that literally no amount of money can bypass?
It is a fascinating tension between the limitless ambition of software and the cold, hard physics of silicon.
It really makes you think.
Definitely something to explore on your own. Maybe think about it the next time you ask an AI a question and get an answer in a fraction of a second. Thanks for joining us on this deep dive.